My name is Maria Bezubova, and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz! Today is December 9th, 2024, and it is a weekly markets update. Let's have a look at the news of week 49 and see what are the next trends. Usually slow week in front of the holidays was marked by rumors about next Indian tender that is expected to be announced very soon, most likely in upcoming couple of days or even hours. During the conference of Fertilizers Association of India held last week, there were discussions about 700,000 to 800,000 tons of urea at least needed for Q1 2025, amid healthy demand in Q4. This expectation has driven the round of short coverage sales by Egyptian producers that started at $358 FOB and finished at $371. At least 60,000 tons were sold, for shipment mostly to Europe. In Europe, demand starts to emerge, but volatile prices prevent buyers from key markets like France or UK step in big times. However, high gas prices that push domestic producers to halt production is the basis for optimism for urea suppliers that expect significant demand from Europe to materialize in January. Ukraine was quite active in purchasing for prompt shipment last week, mostly of carb product. 10,000 to 15,000 tons is expected to head to the market very soon. Turkey also started to purchase more actively after a period of slow market activity. The main purchase season will also emerge in January. However, last week around 60,000 tons of both granular and prilled product were sold to Turkish market for shipment in December from Egypt, Black Sea and prills from Baltics. Nigerian producer Dangote closed a sales tender for 3 lots of 30,000 tons each. Offers were reported at the level of $320 FOB. In Ethiopia, after the last tender for 200,000 tons, another tender emerged last week, now for 821,000 tons. Shipment scheduled to be announced later. Middle East producers are waiting for the next Indian tender announcement, keeping away from immediate spot sales. Thus, spot prices firmed just marginally to the level of $340 to $45 FOB, and only several deals were heard to be conducted. Sales tenders of Iranian producers from last week haven't provoked any firm buyers' interest. Producers start to decrease production capacity due to seasonal gas diversion to the household's consumption. They expect more cuts as soon as colder weather is expected to arrive at the end of December. In Brazil, demand remained subdued, but price offered picked up together with international prices, to the level of $340 CFR. There was no purchase activity though. In the US market, demand also is very slow. However, growing international prices kept NOLA barge price from decreasing. In general, import lineup this fertilizers year lags behind previous seasons. Market players expect, though, that import space will increase as of January, because clearly there will be more need in imported product to cover demand of the next agricultural season. Paper values mostly corrected upwards amid rumors of the next Indian tender. Egypt FOB increased by $10 on the background of actual sales and tender anticipation to the level of $370 FOB for December and January, while remaining unchanged for February. Expectations of sluggish demand pushed NOLA FOB future price down again to the level of $313 to $14 for December and January, while February is expected to be more optimistic due to demand uptick. Arab Gulf FOB was unchanged. It will move as soon as the next Indian tender details will be clear. Brazil CFR level marginally corrected upwards, more due to international price offers rather than based on actual changes in the market. CFR level is evaluated at $333 average for upcoming 3 months. Ammonium sulfate standard product price in China remains stable to slightly firming last week at the level of $130 to $35 FOB. In Europe, some demand emerged because of increasing nitrates prices on the back of growing natural gas price. The indications were in the range between 175 to 85 euros FOB Northwest Port. Turkish buyers were not active last week. The market is waiting for arrival of previously purchased significant volumes. January-October imports this year hit over 800,000 tons, which is 26% above last year amount. Taking into account difficult economic situation in Turkey, market players expect next season importance of ammonium sulfate will increase, because it is the cheapest source of nitrogen in any case. So all those farmers who will need to save money, and there are a lot of such farmers, will likely invest into sulfate rather than more expensive urea or other options. Granular FOB price in China decreased slightly to $140 level amid very slow demand in Brazil. However, most of the floating volumes are sold by now, as market participants say, so the pressure at Brazil's CFR prices should go down now. Pupuk Indonesia is expected to announce the date of final round of the tender issued last week for purchase of 99,000 tons of AMSUL. So perhaps more information will follow later this week. Nitrates prices in Europe continue upward correction amid increasing gas price. LAT Nitrogen announced last week curtailment of the production at its Linz plant, which produces urea, CIN and NPKs, at least till the end of the year. As many market players evaluate, January will be an important month that will show direction of the market. If demand doesn't pick up significantly and elevated price level is widely accepted by the buyers, there will be more production curtailments, that's for sure. As we discussed last week, urea production at most of European producers' plants is already a loss. So, the only way to keep going for producers is ensure healthy margin at nitrates production. And sell, sell, and sell. For now, even the announcement of LAT Nitrogen hasn't brought buyers back to the market. UAN demand is still subdued, and producers both in Europe and the US are in comfortable position in front of the season. Increasing urea price keeps their hopes high, but actual market direction will be evident in January onwards. In ammonia, the week was mostly uneventful with no spot activity or changes in the prices. In Europe, CFR prices remained at the level of $615 to $25. Indian demand is robust. Buyers are looking already for February supply because December-January demand is covered. Prices are also stable at $440 to $60 CFR. In the Middle East, supply is limited and already no spot volumes are available for December shipment. The largest news in the phosphates market is that China phosphates exports ban. Some market players hope that small cargoes may still be able to get out, but most likely exports will not resume before end of Q1 next year, as it was previously. In India, certain activity is ongoing. First of all, there is expectation that the government will increase maximum retail price in front of Kharif season in order to make imports profitable. It will, of course, help to ensure timely stocks built up. Currently, stocks are evaluated at the level of 1.4 million tons in November, down from previous evaluation. Secondly, RCF has scrapped its tender for purchase of 200,000 tons that closed on December 2 due to no interest from suppliers. Also, Indian government is in discussions with OCP for supply of 700,000 tons of DAP and 300,000 tons of TSP to be shipped during Q1 next year. However, there are rumors that India may resell the TSP acquired from Morocco previously, possibly to Bangladesh. Seems like TSP purchase was conducted only in order to get DAP finally. In terms of prices, there is no movement in India or Pakistan so far. India is not the only active buyer now. Ethiopia issued one more tender last week. Together with urea, they are planning to purchase 611,000 tons of DAP. We will watch how much in fact EABC will purchase, also taking into account Chinese export ban. Brazil demand is subdued. Some market players indicate that with MAP prices remaining high around $635 CFR, despite liquidity issues, farmers look more to SSP now. In the US, activity at NOLA has picked up a bit, with DAP barges traded at $555 to $60 per short ton FOB for December-January loading, which is a $5 to $7 decrease from the last week. Moving to the fundamentals. European natural gas futures dropped to 46.3 euros per megawatt hour, their lowest in over 2 weeks, after Russia eased payment rules for gas purchases, reducing fears of supply disruptions. Now, foreign buyers can use third-party banks to convert payments into rubles and transfer them to Gazprom Bank, avoiding complications from US sanctions. Although Europe has diversified its gas sources, faster than normal storage withdrawals this winter have heightened vulnerability to potential disruptions. Current inventories are about 84% full, which is a bit lower than last year's levels. At the same time, increased liquefied natural gas imports and mild windy weather forecasts are helping ease supply concerns. US natural gas futures dipped towards $3 per MMBtu after a smaller than expected storage drawdown reported by EIA. Utilities withdrew only 30 billion cubic feet below market expectations of 43 billion, leaving very healthy inventories. On top of that, weather forecasts suggest a shift from colder than normal weather until end of last week to warmer than normal conditions afterwards, likely reducing heating demand. And on the supply side, December production in the lower 48 states rose month to month in November. For 2025, market analysts anticipate more production increase, driven by stronger LNG export demand and recovering prices. Agricultural commodities future prices increased for all major crops. Wheat futures rose to almost $5.5 per bushel, reaching a 2-week high amid concerns over deteriorating Russian winter wheat conditions and Ukraine's wheat shipping disruption. Analysts predict that 37% of Russia's winter crops are in poor condition, compared to just 4% a year ago, marking the worst assessment on record. Moreover, many of these crops may need replacement with spring plantings, creating uncertainty around next year's harvest. Further supporting prices, Ukraine's wheat shipping capacity faces potential threats, with its 24-25-year wheat exports projected to decline by 14%. However, Argentina's wheat production may exceed earlier forecasts, as farmers report better than expected yields during the ongoing harvest, tempering price gains. Corn futures rebounded a bit from the lows of last week to the level of $4.31 per bushel. But in general, corn price remains under pressure, and the main factor of uncertainty is demand from China amid potential tariff war with the US. Potential for record 2025 South America corn crop also offers resistance in corn futures. Next week, USDA will issue new US and world supply and demand estimates. Trade looks for only a slight drop in US and world corn end stocks. USDA could leave South America corn crops unchanged from November, but some crop scouts could see final crops even higher if weather remains favorable. Soybean prices stabilized just below $10 per bushel, underpinned by strong production outlooks in Brazil and improved weather in Argentina. Brazilian soybean output for the 2024-25 season is forecasted to hit record levels, with Cellares Agency estimating it at 170.8 million tons, nearly 1 million tons higher than previous projections. Meanwhile, much-needed rainfall in Argentina's key farming regions has boosted soil conditions as planting progresses. Moving to the shipping industry. Containerized rate index remains stable last week. Spot rates ex-China are expected to increase in an upcoming week or two. And it will be not only due to potential tariffs for trade from the new US administration, but also due to looming ILA port strike in January 25, and the anticipated rush to ship goods before the strike begins. The ILA, International Longshoremen's Association, warned last week that a breakdown in negotiations with the US Maritime Alliance over the contentious issue of automation and semi-automation could lead to another coast-wide strike within 6 weeks. The tentative wages agreement that was reached in October assumed extension of the current contract until January 15. And if the final deal is not agreed before that, the new strike might happen. We will watch the situation development. The Baltic Exchange Dry Index dipped to the lowest level during past year. The Capesize market faced a challenging week, reflecting subdued sentiment and oversupply of tonnage in both basins. In Panamax segment, midweek saw life injected into the market across most areas of the Atlantic. Decent levels of both grain and mineral demand added some impetus to a stagnant market, and small gains were witnessed. But in Ultra and Supermax segment, it was another torpid week as rates across most areas struggled to gain any positive momentum. In the Atlantic, both the north and south lacked much fresh impetus. Demand from the Mediterranean waned. In Asia, there was a similar story, as vessel availability was easily sufficient to keep up with demand. And in Handysize, it was another challenging week, with rates in both basins continuing to face downward pressure. So, the general catastrophic index drop is not a surprise. To sum up, activity in urea is spurred by expectation of another Indian tender to emerge within days or even hours. Urea price gain will keep the market level elevated even during seasonally slow couple of weeks in between Christmas and New Year holidays. Increasing price of the natural gas in Europe continues to push nitrates prices up, as well as supports unsold prices. But it also brings European producers at the edge of their financial stability, pushing towards production curtailments. Phosphate prices are supported by steady demand from India and Ethiopia as well, that just announced another purchase tender for more than 600,000 tons of DAP for 2025. Agricultural commodities future prices were all in green amid concerns about planting conditions in some key regions, as well as potential tariff wars that might emerge with the new US administration coming. Cost of containers shipment is expected to increase, also due to potential strike in the US ports in January. Dry bulk shipment activity was slow across all segments, thus the Baltic Exchange Dry Index hit the lowest level in past 12 months. So, let's see what is next around the corner, but it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon.